All right, so we're on learning objective 9.3. We are going to be talking about the allowance method. Remember, there are two allowance methods. There's percent of sales and aging of receivables. The journal entries for both methods are exactly the same. The only thing different between these two methods is how we calculate the bad debt expense. Okay, so don't get confused thinking you got to learn journal entries for two different ones. They're exactly the same. Only thing different is how you calculate the number. Okay, so we're going to introduce a new account called allowance for bad debt. And I am going to jump over here to this page where I drew both of these T accounts out. Let's take it one at a time. Okay. Accounts receivable, current asset, has a beginning balance. Putting words here just so, because sometimes a whole bunch of numbers kind of is confusing, but words sometimes kind of help. So we have beginning balance. We're going to increase accounts receivable by any credit sales. We will decrease it with any customer payments and any write-offs. Okay. We will end up with an ending balance. This should never flip over to be a credit balance in accounts receivable. That would probably indicate something is wrong. Okay. So we're now allowance for bad debt is a contra asset. These two are married. I know that's really cheesy. They're married till death do them part. Under the allowance method, these two are always going to be together. Okay. So in this contra asset, we have a credit balance. We hope that it's a credit balance. It's going to be a credit balance at the beginning. Any bad debt expense, we will add to it. Any write-offs. This write-off right here will be exactly the same number between right there. Okay. We have an ending balance. The kicker on this one is that it actually could flip over to be a debit balance. What that means is you wrote off more in that column than you actually accounted for in bad debt expense. Okay. These two accounts together, accounts receivable, I sometimes just abbreviate allowance for doubtful accounts, allow. That would give me my net realizable value or net accounts receivable because we really don't anticipate in collecting that much. Okay, that's what's in there. So basically, what's happened is we don't really know who is going to not pay their bill. We just know a certain percentage is not going to pay their bill. So we stick this over into a different pocket. As we find out who did not pay their bill, then we will write it off. Now, because remember, if we had a crystal ball and we knew who was not going to pay their bills, we would have never extended credit to them, right? Okay. All right, let's jump back over here to the PowerPoint. So we've kind of talked about net realizable value. So now let's look at, um, they say as of, we're going to look at an example, December 31st, 2026. Smart Touch Learning estimates that $80 of its 4,400 accounts receivable are uncollectible. Okay. So they're telling us the number. You're going to actually have to learn to calculate it. They told us right here. The journal entry will be to debit bad debt expense, credit the allowance for bad debts. Okay. In the previous method, the direct write-off method, you could see debit bad debt expense, credit the accounts receivable. That's a direct write-off method. That is not an allowance method. Okay. You will see this entry going to bad debt expense always at the end of a period because it's an adjusting entry. Okay. And we don't know who the $80 is that's going to go bad. We just know $80 is going to go bad. Okay. So we are going to put it over into a different pocket. So when we figure out who, we will write it off against them, like I showed you in those T accounts. Okay. So here's what their balance sheet's going to look like. Okay. This is that net realizable value, accounts receivable minus the allowance for doubt for bad debts. Okay. All right. So we're going to look at the next example on writing off an uncollectible account. So on January 10th, 2027, Smart Touch Learning determines that it cannot collect a total of $25 from its customer, Sean Clark. Okay, so we're not going to mess with the bad debt expense because we've already done that at the end of the previous period. Okay, now we are just going to debit the allowance for bad debt and credit the accounts receivable to Clark. Remember, I did this right here. Okay. If you want to stop the video, take a picture of that, I'm okay with that. If you're watching these videos while you're doing a video quiz for me, you also have access to these in the Word document that has all of the Principles of Accounting 1 and 2 playlist in there. So you have access to all of that. Okay, so this is a write-off. All right. Then so the entry to write off the receivable reduces the amount in the allowance account and it reduces the accounts receivable, but it doesn't affect the net realizable value. Okay. As illustrated here, if you took both of these numbers, if you took 25 off of that one and you took 25 off of that one, your net realizable value is going to be exactly the same. So that's a trick question they love to ask. After you wrote off this, how did your assets change? They didn't. How did the net realizable value change? It didn't. Okay. So you can see here, prior to the write-off, we had 4,400 in the accounts receivable, and minus 80 gave us a net realizable value. After the write-off, we had 4,375, which is just this number minus 25, and then this number minus 25 gives us 55. Notice our net realizable value is exactly the same. Okay. All right. So let's look at another example. So we're going to recall Smart Touch Learning wrote off $25 for Sean Clark on January 10th, 2027. It is now March 4th, 2027, and Smart Touch Learning unexpectedly receives the $25 from cash from Clark. Okay. Remember in the previous one that a lot of students, after we write it off, they want to say, oh no, we don't want your money. We've already wrote that off. Yes, we do want your money. We will figure out the journal entry. Okay. So we're going to reestablish the account. It works exactly the same for direct write-off method, except we're going to come back here where the write-off was and we're going to reverse that entry. Okay. So we are reversing that entry, reinstating that receivable. Okay. Then we're going to get the cash and make that receivable go down. Remember, we cannot combine these two entries. It looks like we could. We could just debit cash, credit allowance for bad debt. No, we cannot, because we need to show that Clark paid their bill. Okay. All right. So we're going to look at a little bit of difference between the direct write-off method and versus the allowance. Okay. So let's take this. Let's mark one out so that you focus on one. Direct write-off method. They would debit the bad debt expense for 25, credit the accounts receivable for 25. Okay. Over here, it is, look, the credit's exactly the same. So, hey, if you can get the credit right, then it would be a good thing to get at least half the entry correct. Okay. Under the direct write-off method, we would debit bad debt expense. Under the allowance, we would debit that contra account allowance for bad debts. Because remember, we set aside so much money that we knew was going to go bad. Okay. Then when they recovered the account, we reversed the entry. Both of these are reversals of the original entry. Okay. Then actually collecting the cash, those are actually the same. Okay. I like this because it's really good when you can kind of see journal entries that are different and which ones are the same. Because you know what? Those are a couple of boxes. You can get correct and get partial credit, and that partial credit may end up making you pass the class. Okay. There is no adjusting entry when it comes to direct write-off method because we're not going to be looking at anything. We're not looking at an estimate or anything like that. Okay. There is an estimate, there is an adjustment when it comes to the allowance method because we are continually doing this over and over at the end of each year. Okay. All right. We're going to do objective 9.4 as well as 9.3 in this video. So now, how do these companies come up with these estimates? Past experience, the industry in which they operate, and there's other variables. But basically, what's happened in the past? Which number in the past has been a more reliable number? That's the one you want to use. Because I could argue any one of these, but if you can get a number that is the most reliable, that means your financial statements are as correct as possible, even with some estimates going on in there. Okay. So let's do the first one, percent of sales method. I kind of go easiest to the hardest here. The direct write-off method's the easiest, okay? We're going to the next easiest. This one is a lot simpler. The other two are going to be a lot more complicated, so just hold on with me, okay? Enjoy the easy for right now. All right? They're going to look at sales. What's our total sales? That's why they call it an income statement approach. They're not looking at the balance sheet. They're not looking at accounts receivable. They are looking at sales. Okay. So Smart Touch Learning uses the percent of sales method to account for uncollectible accounts. Past experience suggests that 0.5% of credit sales will be uncollectible, which amounted to $60,000. They just told us, they didn't even make us calculate that. But just remember, that's a 0.5%. So if you're moving your decimal place, you've got 500. That's how you're going to put it in your calculator. Just be mindful of your decimal points and putting it in your calculator. Okay. So, oh, they said the credit sales were 60,000. Okay. Got it. I thought they were calculating it for us, but they were not. Notice how that's just what I said. Make sure you don't mess up on those decimals because that's real easy to do, especially when they give you something like 0.5%. Okay. Just, or you can put it in your calculator, put it as a percentage. It'll automatically do that for you. You're not banned from using calculators on your test. You cannot use your phone calculator on a test though. Okay. So that tells us that $300 will be uncollectible. We don't know who, because remember, if we knew who was not going to pay us, we would have never extended credit to them, right? So we're going to make the entry to debit bad debt expense, credit the allowance for bad debts, and that's it. Okay, we're done. We don't have to really do anything else. Okay, they are going to show us in T accounts. They said after posting the adjusting entries, Smart Touch Learning has the following balances. Okay, so they had an ending of 63.75 for the accounts receivable, ending in the allowance account of 355. Notice that 300. Remember, these are the T accounts that I just showed you right there. Okay. They're just a little prettier than mine are. Okay. That $300 came down here because we debited bad debt expense and credited the allowance for doubtful accounts. Okay. Now we're going to look at percent of receivables method. Okay. We are looking at a percent of accounts receivable. That is an asset. We looked at percentage of sales, which was revenue on the income statement. Okay. So the first thing we're going to look, determine the target balance of the allowance for doubtful accounts. Okay. Basically what we're doing, if you kind of come over here, in the percent of sales, we calculated this number first. Okay. When we're doing any kind of receivables method, let me erase a few things here to not muddy up the water so bad. We're going to calculate the ending balance first. Then we will back into the bad debt expense. Remember, I told you calculate the journal entries are the same, The only thing different from the income statement to the balance sheet method is how we find the number. Okay. We are calculating the ending balance. So in this question, we're going to find what the ending balance is in allowance for doubtful accounts. So let's just go through this one right here. It says on December 31, 2027, Smart Touch Learning's unadjusted accounts balance was 6375. 4% of accounts receivable is estimated to be uncollectible. The allowance for bad debt account has a credit of $55, so an adjustment of 200. Okay, let me fix that. So I'm going to come over here. I know it's already in a T account, but I want you to watch me. Okay, I'm just going to abbreviate allow. Okay, we had a balance in that account of $80. That was my beginning balance. We wrote off 25 and we just went through the calculation to figure up what the ending should be. Okay, so the ending of this account should be 255. Yes. So we're going to get to the 50, we're going to get back. That 55 is just really the combination of those two. I just don't want to confuse you too much. Okay. So we got to end with $200. I'm sorry. I didn't mean to confuse you. We're wanting to end with 255. And we're trying to find the number that we will back into that to make that work. Now, this can be an algebraic equation, okay? I went over there and I showed you how these are. When I draw a line right here, that just means total. So we could write out an equation. We could say 80 minus 25 plus, I'll just put a box here, whatever our bad debt expense is equal to 255, okay? They've already done the math, so we don't really have to. But I would take the 255 and I would work my way backwards to get to this 200, just like an algebraic equation. Once you put the 200 in here, take the 80 minus 25 plus 200, make sure it comes out to 255. Okay, it is just how we find the number that is the difference between these two methods. Okay. Then we're going to debit bad debt expense, credit the allowance for doubtful accounts. These things did not change. Okay. After posting this, we end up with $200 in bad debt expense. Notice our accounts receivable stayed the same. And then we came in here and we now have a 255 credit balance in our allowance for doubtful accounts. All right. So now we're going to get to see how this could change if we had a debit balance. Because remember, I told you the allowance actually can flip over to be a debit balance. So I know they're going to do this for us, but we're going to do it anyway. Okay. It says Martin's Music has a debit balance of allowance for bad debts of 150. And then it estimates that 2% of 40,000 will go bad. I'm using my phone calculator. They are saying that is the ending balance because we are using accounts receivable. We're a balance sheet method. So we are calculating that 40,000 multiplied times 2% is 800. That's what we want to end with. We want that to be our ending balance. We are going to back into the allowance for bad debts. A lot of people want to come in here and say, oh, 800 minus 150. That's actually not correct. We're going to add the 150. Because to get from a debit of 150 to a credit of 800, we've got to add them together. Okay. So that means our bad debt expense would be $950. Yes, I know they put that T account there, but they gave you all the information you needed. You got to watch me work through it, And the journal entry will be to debit bad debt expense and credit the allowance for bad debts. All right. Now we've got one more thing and then we'll be done in this video and almost done with chapter 9. Okay. We're still doing a balance sheet method. We are just looking at this a little bit differently. Okay. If you've ever gotten like a bill from a doctor's office, you will see that it'll have an aging schedule on the bottom. Like you might have a 0 to 30 days. Okay. There might be an amount in that, or 31 days to 60 days. And then it'll have up and up and up. This is why they do that. Okay. Right here, because we're going to age all of those receivables and we're going to see how old they are, because the ones that are the oldest are very likely not going to be collected. Okay. So there's going to be a percentage difference for each category. Okay. This is an aging receivable. Don't let it confuse you. Okay. Don't stress. Okay. Just look at it. Here's all your customers, how much they owe, and where they end up in this aging category. Okay. We have 1 to 30 days, 31 to 60, 61 to 90, over 90 days. Okay. I don't know why they did these totals out here because they really don't matter. It's the totals in those categories. So they have defined that if it's in this 1 to 30 day category, then only 1% is going to go bad. If it's in this next category, 2%, then 3%, and then boom. Anything that's over 90 days, there's a 90% chance it won't be collected. Okay. So this is actually probably what happens most often when it comes to receivables, because you can clearly see how the older it gets, the higher the uncollectability will be. We're going to take each one of those balances, multiply it times its percentage in each category. So we end up with 4 different numbers, and then we're going to total them all up. That is going to be your ending balance in the allowance for doubtful accounts. Okay. Sometimes I like to just jump to the diagrams rather than read all the words. Okay. So this was the same example as earlier. They had that $55 in as a credit. The ending balance should be 185. So our bad debt expense will be 130. So remember, we are calculating the ending balance when we're using a balance sheet method, either percent of receivables or an aging of the receivables. Okay. And there's the T accounts. And so then they have a comparison of each allowance method. This is a really good summary slide. It's a really good spot to review right before you take a test so that you don't get too confused. All right, that is all for learning objective 9.3 and 9.4. We'll do one more objective, 9.5, and we'll be done. I will see you in the next video.